Hey everybody, welcome. This is Troy at Garris and the Mortgage Banking live stream. Today we're going to talk about a few things. Is business still as strong as it seems to be? Are there risks in default servicing? And we're going to have special guest Josh Weinberg of First Line Compliance. He's the president over there, and he's also EVP of Compliance at Guaranteed Rate, an amazing mortgage lender out there, 50 states wide and strong. We will have him on and we'll ask him what keeps him up at night. This is the Mortgage Banking live stream. Welcome everybody. So we're going to talk about a few different things, as I mentioned. One, before we get started though, I just want to say one thing. A true gentleman in our industry, a long time knowledgeable professional, and somebody who is both a friend to industry and the public, and also actually a good friend of mine, and I value that relationship dearly. Brian Montgomery was confirmed yesterday by the Senate to be his official title is Deputy Secretary of HUD. That's the number 2 position, reporting directly to Ben Carson. And I know that Brian has an experience that will serve the public and serve industry well, and also has a personal story that I think is quite moving, and hopefully you guys will get a chance to hear that sometime if you haven't already. And as I mentioned, Brian is really a true gentleman, and we are lucky to have him in that position, especially at this time. A couple of business items to get started. So first question is mortgage business strong? It definitely is by lots of reports. Lots of lenders out there reporting record volumes in applications, record volumes in people coming in the door and seeking mortgages. And there's some good hiring going on as well. MBA came out with some good reports this week. In its weekly reports, purchase apps are up, particularly strong in certain states, some of the bigger states, and so lots of opportunity out there. And again, in the hiring space, people are hiring in production, people are hiring in ops. There's lots of good news in that regard. And at this moment, where we have so much bad news on the horizon every day, if you open up the newspaper, you listen to the news, you watch the news on your various apps, you see that there's just a lot of grim information and news that's coming out. But there really is some gems in the mortgage industry, and I think we should think our blessings in that sense. There is, I note, some information that is looming on the horizon that we have to be concerned about and think about how we prepare for that and how we try to get through whatever may come our way. And nobody really knows, of course, what is coming our way. But I'll point out some pieces of information that I've picked up just recently. For example, deficiencies are way up. The information out of the MBA says that nearly 4 million homeowners are currently in forbearance. Nearly 8% of loans are in forbearance. Just 2 months ago, that number was 0.25%. So from 0.25% in 2 months, just over, we're near 8%. So there's some cautions out there that we need to be thinking about, and hopefully we'll be able to get a little information from Josh today when we bring him in, and he can talk about some of the ways that people might be able to prepare for what could be coming. And hopefully, I know a lot of states are opening up, and hopefully this will be a positive sign, and hopefully the virus problem that we've been wrestling with can be held at bay, but we do not know. And so I think the most important piece is going to be to how do we be prepared. So that's on the business side, and a little strategizing there that we can talk to Josh about. A couple of brief items on the compliance and legal side, just before we get started and bring Josh in. HUD, the CFPB, and FHFA jointly put out a website. Just yesterday they announced it, And this is a website that's aimed at helping homeowners, helping Americans, borrowers, figure out what kind of relief might be available for them. And in particular, 3 items stand out that I think might be helpful to people who might be wanting information. One is what types of mortgage relief options are available to people, particularly for the lenders that are here and that that are active in our community. That's good information, because they're getting overwhelmed with calls about what types of relief are available. And so hopefully some of this information from the CFPB and FHFA and HUD can help point them in the right directions. Also, there's information about protection for renters. There's a piece of the website where people can go on and figure out whether they're entitled to some sort of option relief as a renter, and then also how to avoid scams, because homeowners, renters, others are always susceptible to various scams, and wrongdoers are always out there trying to cook up new schemes and take advantage of people in times of when they're most vulnerable. And at the moment, there are people like this, and so I'm glad to see that the regulators are on point there, trying to get information out. Another brief item: the CFPB recently settled. This week it announced a settlement with a default servicer. I think that default servicing is going to be an increasing item in the news, an increasing item of interest. And just coincidentally, this particular servicer settled for a pretty big sum, actually. These are all allegations, of course, as you know, but a consent order came out. There's $1.2 million in consumer relief involved in this settlement, plus $250,000 in civil money penalties for alleged wrongdoings in RESPA servicing standards and also the Consumer Financial Protection Act. Some of the items that were noted in the allegations were prohibited foreclosures, where borrowers were really entitled to loss mitigation protection, and this servicer allegedly did not follow those requirements, and also failure to send evaluation notices timely, again in compliance with the rules in loss mitigation, and so these were the primary allegations. And one point to note in these settlements, the headlines are always the dollar figures, right? So 1.2 million in settlement, $250,000 in civil money penalties. Those are always the eye catchers. But I think lurking there, from my perspective, lurking there, that's the bigger problem, the bigger risk potentially, is the problem of these settlement agreements, these consent orders always contain provisions that talk about what you have to do going forward. And so this servicer has to have various procedures and policies in place, and it has to follow those. There's an injunction effectively to not violate the law in the future. And if the servicer or in any party to a consent order, if they do in fact violate the law in the agency's mind going forward, that's a reason to go back in and yet again enter negotiations, or perhaps take the entity to court at that point for violation of the obligations that they've agreed to in these consent orders. So again, that's involved in almost every consent order I've seen, and it's an area where people need to be particularly focused, both when they're negotiating these settlements, and then also whenever they're complying and living with these settlements for a number of years past the actual consent order itself. So that I can send you this information if you want to. You just reach out to me. My email, troy@garrishorn.com, or my phone number. The information is down below. You can see it. You can just find it there. It's got my phone number and my email. You can also comment on the YouTube site here and on this live stream, and we'll get your questions answered. A couple of thank you, Burton Embry. I appreciate it. There's Paul Kanag. There's some great people involved in the industry, and I appreciate their participation here. Sue Gamboa. Sue is an old a former colleague of mine. She's now over at Finance of America. Thank you guys. I appreciate the support and the good wishes. And without further ado, let's bring in Josh Weinberg, of President of First Line Compliance, and again, also EVP Compliance at Guaranteed Rate. Let's patch him in and just ask him, Josh, what keeps you up at night and what's got you going these days?
Well, hey, Troy, thanks for having me on. Good morning and good afternoon to everyone who's participating. Thanks for the opportunity. Man, what keeps me up at night? I've got a lot of reasons I don't sleep these days, and actually one of them is not TRID first. So in about 10 minutes or so, I want to try and cover 7 or 8 topics, which anyone who's seen me talk before is not an easy feat for me. So I will try and speak deliberatively, not too fast, but cover the topics. I will say that this is going to be a very cursory or high level review. To dig deeper, if we can help at all, First Line Compliance would love to work with you and help talk through and work through these issues. So a couple of tasks or issues, topics that are I'm thinking about these days. Probably most hot button, forbearance and what's happening under CARES Act. So there's a lot happening. Some of the most frequent questions I receive are things like, well, what happens to a borrower who's had a forbearance but has kept making payments but now wants to refi? The answer I've heard is we have to follow what's published. The existing guidelines from Fannie and Freddie say if a borrower has a forbearance, they're not eligible for financing for 12 months. Fannie and Freddie and the FHFA have been promising to get updated guidance or more information, potential relief to that guideline. I've been hearing it's supposed to come on Monday for about 5 weeks now. So I'm not holding my breath that we'll get it soon, but it is an issue that FHFA and the agencies are dealing with and thinking a lot about. In addition to forbearance, I've heard some questions about more recently, do we think there's an issue from the fair lending or ECOA perspective related to public assistance, whether that be unemployment insurance or the fact that there may be forgiveness or assistance related to their mortgage? So unemployment insurance, yes, I think is public assistance. That's pretty clear. I think there's a question as to whether CARES Act forbearance is public assistance or not. Assuming that it is, again, I think there's a question of whether that is. Assuming whether that is, I think it's really important of how we as lenders discuss our credit decisions and make clear that any adverse action is not based on the fact that the consumer receives any form of public assistance or, again, maybe participating in the CARES Act forbearance. Our reasons for denial have to be specific according to the credit guidelines. Fannie and Freddie, again, their published guidelines make clear there are different sections under income from public assistance, income received from temporary sources, and also unemployment insurance type qualifications. The main things to look at here are consistency of employment and continuity of income. In most of those 3 scenarios that I posed, there's going to be a challenge in documenting or proving consistency of employment, continuity of income, and potentially that the borrower has an ability to repay their loan under ATR-QM. So do not deny anyone because they're under CARES Act forbearance. But if the credit guidelines show that the borrower is not eligible, make sure those denial reasons are based on the credit characteristics, not a fact of CARES Act forbearance. More to be seen there. I also think, as Troy had...
Josh, if I can just interject one moment there, is how do you figure out whether people are in forbearance or have applied for forbearance? Because borrowers are not always, they don't always remember everything. They may not know.
Yeah, great question. So one area, look at the credit reports. Forbearance is being reported under the FCRA, the Fair Credit Reporting Act. Servicers or anyone who are reporting credit is required to accurately report the status of the borrower, which means that if they're in forbearance, it should be indicated that they're in forbearance. However, that forbearance listing should not be deemed as non-payment or shouldn't negatively impact the consumer's report. We'll have to see where that leads. One other thing I've seen pretty common in the industry is many lenders have included an attestation regarding forbearance prior to or at closing. where the borrower is attesting they are not currently in forbearance and do not anticipate in the immediate future them losing their job or being needing to go into that, to take advantage of that forbearance program.
Yeah, that makes sense. That would seem to be a pretty big ATR problem, as you mentioned, right? If they make a statement at closing, just before closing, and saying, "Yeah, you know what, I'm gonna have to get a forbearance as soon as I close this loan." It raised some real questions, I think.
I think that's right. And what I've heard, at least indirectly from the agencies, is the reason a borrower who's in forbearance, even if they've made their payments, are not eligible, is because CARES Act forbearance requires an attestation of hardship. Once a borrower's deemed themselves to have a financial hardship, Fannie typically, or the agencies typically, want about a 12-month seasoning for the borrower to have reestablished credit, to have gotten past that financial hardship and make them again eligible for qualifying. So look to ATRQM. There is information on determining how we determine that reasonable ability to repay. Helpful to look at.
Makes sense.
I promised I would be brief. I already went way over on that one topic, so I'm gonna have to go fast.
I interrupted you. Go ahead.
Not at all. So one point to follow up on Troy's point, we have incredibly swollen pipelines from the origination perspective. One things I think that we as lenders need to do is evaluate that pipeline with a keen attitude towards fair lending in ECOA, making sure people are not discouraged from applying, making sure that if we're denying someone, we're providing the accurate written notice and making those decisions based by people who are authorized to have credit. However, and that all being said, it's really important that we review our pipelines and get confirmation from the borrower as early as possible whether they've lost their job or had a loss of income. Underwriting a loan is expensive. Closing a loan is even more expensive. And having to scratch and dent a loan that's gone into forbearance or sell it to the agencies at a 5 or 7 point haircut is even more expensive. So what many lenders have to do is evaluate, of all these loans that we have in our pipeline, how many of those are potentially impacted by borrowers with hardship. If we can identify those and prevent them from going as far down the operational process in our shops, that will save us considerably and also allow our teams to focus on loans that have a greater likelihood of closing. To follow on that, what we're seeing now in origination, 3 to 6 months from now, anticipate we are going to see increases from the loss mitigation, potentially forbearance perspectives. And starting probably next month, look at your QC departments. All of the volume that started in March is going to start hitting them next month. If you haven't staffed up in those areas, you might need to, or look for potential resources for help, because your sampling selection, your percentages can't change, but because of the volume, you're going to have a much higher number of loans or files to look at. So start planning for that as soon as you can. Okay, another topic, temporary authority. This is an issue that's become very important both for originators coming from banks as well as from other lenders. Temporary authority allows 120 days for the LO or potential LO to be able to act with the authority as if they had a license. Because of the shutdown of testing centers and fingerprinting locations, many people are looking at having that temporary authority, that 120-day time frame, expire. This has been brought to the Bureau's attention. I do not think the Bureau will have an answer before TA starts expiring for a lot of folks. So a couple of suggestions. One, testing centers have begun to open. So even if there's one not directly located to you, look if there's one in a nearby state or county. That might help. Fingerprint locations, I'm also hearing, are starting to open. And from broad statistics, I'm hearing we're about a 50% reopening. Also, particularly if you're a larger lender, try reaching out to Prometric. That's the company that hosts the tests for NMLS. They are currently in beta with a few lenders to allow remote testing. So that may be an option as it becomes more available, and something industry I think really would welcome. Not having to have that burden of going into an actual location, but still being able to have a legitimate proxy NMLS test. Similar, we've talked a lot about staff working at home. We have two considerations. Many states have issued temporary allowances to have people work from home and not consider that home office a branch. What happens when those temporary orders expire? Are you going to have a flood of home offices needing to be licensed as branches? Something to think about. On the other hand, have you started thinking about what it looks like to bring people back to work? Are you going to do it all at once in phases? What are the steps and issues you need to look at, both from potentially reasonable accommodations for employees who may have disabilities, as well as to just general safety and what it looks like for bringing your team back to your office? Similar state issues. Don't lose track of state issues. In particular, the District of Columbia had a requirement last week that we send them reports of loans that have been in forbearance or have requested forbearance. There was a lot of hubbub, a lot of commotion around that because it was communicated or was clarified relatively quickly. This is something we can't slip on and expect to see more action from the states in similar areas. Along those lines, exams have not slowed down. In fact, I've heard at least one state say exams is one area we're using to keep our state employees employed. So the pace of exam and the frequency of exam is going to continue to escalate. You cannot get too comfortable thinking we don't have to worry about this, we have other problems. Exams will be important. And in saying that, make sure to work with your examiners to keep them informed or aware of the pressures you're working with, especially if you have other exams that are ongoing. Internal audits as well. Don't lose track of internal audits. We all most likely have internal audit schedules. We're going to be expected to follow those. To the extent we make changes, make sure we've adopted our internal audit plan and choreograph that with senior management or board approval so it makes sense in our overall risk perspective. Along the reporting from DCs, but separate, VA IRRRLs. We now have an ongoing quarterly reporting obligation to report VA IRRRLs that may have a defect. Look at that. Look at the letter from VA. This is going to be an area where there's going to be continued emphasis and focus, and making sure that we're doing the calculations correctly, like for recoupment or the seasoning or what have you, is going to be tested. And when we make a mistake, we're going to have to report it. Apparently, this is a hot button issue because my face is turning red as I'm talking. I will also say the notion of self-reporting to the agencies, to HUD for FHA, for Fannie and Freddie, another area to keep in mind of, and to have that governance perspective, both reporting outside externally as well as internally and escalating up. Having senior management and board awareness of all these issues is really important. Two more quick topics. LIBOR is not LIBORing. We have requirements coming next month in June. Some investors have started adding requirements in May. The first requirement is that we've added the fallback language to LIBOR ARM notes. The MBA has a lot of resources available. I'd be happy to talk through this with you again. There are steps and timelines we need to take. Another area, New York DFS has been leading in this area, primarily because the New York Fed is a leader in the ARC working group. So this is an area where, again, we need to pay attention, and this is going to have a trailing impact. The agencies, different aggregate investors have set deadlines for when they will stop buying LIBOR ARMs, as well as the last date applications can be taken for LIBOR ARMs. You don't want to be caught in a scenario where you have a pipeline full of LIBOR ARMs that either don't have the fallback language or that you can't sell but are obligated to originate. And finally, one of my favorite topics, limited English proficiency in LEP. As we get more towards the originators or our sales staff getting closer to consumers, both electronically as well as through our marketing efforts, making sure we're aware of state regulations, federal guidelines, or best practices around LEP, as well as kind of the fair lending and equal opportunity requirements around LEP, as well as on the servicing side. LEP has not gotten much attention on origination in terms of enforcement actions or actions against the lenders, but it has occurred in the servicer space, and those are largely centered around failures or lacks of ability of servicers to provide adequate service to easy for me to say, LEP consumers. And in that, let me pause, see if there's questions or more I can go into.
Yeah, so I'll just point out that like I mentioned in the last live stream earlier this week, the CFPB in particular, but also FHA or HUD rather, has focused pretty intensely on fair lending, and so I think on the LEP side, there's some real legal and compliance issues you need to be thinking about. But Josh, I know you're involved in a company called Documents too, and what sort of, everybody is at record volumes right this minute, but it would seem like what sort of types of opportunities are there long term, not just the immediate term, but long term, with regard to people who speak or more readily communicate in a foreign language?
Yeah, Troy, I actually think, and I talk a lot about the regulatory or potential liabilities associated with LEP. I actually think there is far more opportunity than there is risk. So if we look at just some of the demographic statistics, as of 2 years ago, so my data is a little stale, over 22% of the population over the age 5 speaks a language other than English at home. In the next 6 years, less than 6 years, over 75% of household formation will be by minority applicants. That is over 46% Spanish speaking. In the next 14 years, that'll be over 85%. The current group of homeowners, the current group of home buyers, the millennials, is the most diverse generation we've ever had. And the percentage of Spanish speaking or non-English speaking people is higher than it's ever been. Until we get to Gen Z, who's the generation behind them, who are even more diverse and speak even more languages or more prevalently speak languages other than English. What all of this means is in order to reach consumers of the future, we're going to need to speak their language. So Documents actually was born to try and meet some of the TRID compliance requirements. And it basically is under the concept that sending disclosures doesn't work. Adding more disclosures that a consumer won't read or understand doesn't solve the problem. It just adds to it. So Documents uses multimedia, different ways of communicating to try and engage and ensure through interactivity that the consumer actually understands the terms of their loan at a 7th to 8th grade reading level. And it's currently available in English and Spanish, and likely by the end of the year, we'll support the other main LEP languages, Chinese, which is Mandarin, Tagalog, Vietnamese, and Korean. So covering those 5 languages will cover over 85% of the LEP population in the US. And it will do it in a way that is compliant with those state laws and regulations. So California is the easiest. Under their Business and Professions Code and Civil Code, there is a requirement that if you've primarily negotiated, which is an undefined term, but if you're talking rates and terms and fees with the consumer in Spanish, you're likely negotiating. If you've done that, you're obligated to provide at minimum the LE and CD in Spanish. That's under a new subsection that became effective this year. Under the previous section, you'd have to provide them all of the TILA disclosures or the contract documents in that language. Documents as of now is, from what I understand, the only vendor that enables you to generate the actual LE, CD, and TILA disclosures in Spanish. There are other states like Oregon or Texas that kick in once you've advertised in Spanish. So I could talk about LEP for hours. Some best practices.
You love that topic.
Yeah, have a policy around it. Make sure your employees are aware of it, and don't put your head in the sand. Having a policy that says you cannot speak another language is a policy destined to fail and be violated, and regulators are going to become accustomed to that. There are things we can do to put in controls and limit the amount of the transaction or the process that's required. And most importantly, FHFA and CFPB have come up with a disclosure that's available in each of those 5 languages and English that clarifies the transaction will be officially conducted in English, but these are additional services were provided in your native language. And if you need more help, contact these other sources. Things like that clearly articulate to the consumer the expectations of what they can receive in their language and what they will not will go a long way in meeting both the letter and spirit of the law behind the LEP requirements.
And I love it. What you're doing there is you're using compliance to propel business and growth. And I think that's the way that we need to think about these things going forward. Josh, I know you can talk about this for a long time. And I love the topic as well. How do people get in touch with you?
Yeah, please shoot me an email, josh@firstlinecompliance.com. My direct number, 831-325-3369. Again, that's 831-325-3369. And it's josh@firstlinecompliance.com. And you're also, please visit our website, www.firstlinecompliance.com.
Thank you, Josh, and I appreciate you joining today. So just in closing, a couple of quick points. One is tomorrow is our happy half hour, 5 p.m. Central. If you want to join, just reach out to me, send me an email, shoot me a text, give me a call, and you can join the happy half hour. It's alcohol optional, but we are going to focus on a recap of the developments on the business side and the compliance side from this week, what people are finding out. This is cream of the crop people that attend, and good, healthy discussions about information. Garris, my law firm, put out a blog post today. Take a look at that. And if you think we earned it, subscribe and join us again. This is the Mortgage Banking live stream. Everybody, thank you very much. Josh, have a great one.
You too. Thanks again, Troy.